Hello, investors. The month of May has been a very dramatic month. We started the May month with a very big sell off. The market was down about 10%. However, somewhere early in the month, there was a very big global restarting trade. And what you see is a very dramatic pullback in global markets, and especially the NASDAQ. So the world really, which was factoring in that this whole COVID issue would really get elongated and the damage or restarting of economies would take a lot of time, was surprised with the kind of surge or restart or the enthusiasm that governments across the world showed in restarting their economies. Even in India, in spite of the rising number of cases, we had the government making an attempt to restart the economy. So what we saw in May was a restart trade. And that is very reflected by the kind of rally that we see. You'll find that the most beaten down stocks were one that rallied the most. Like in the US, airlines, cruise liners, hotels, the businesses that were expected to be most hurt and where the price damage was maximum, you find that the prices tend to really go up. In fact, stocks almost doubled in a matter of few weeks. So what we saw in May was a very big restart trade globally. And that was actually a very good relief rally for an oversold market. In India also, we saw a recovery. For the month, of course, India has its own set of problems. So we closed about negative 2.5%. Your portfolio underperformed a little bit because at the end of the day, as I told you, that the restart trade is when the most beaten down stocks actually come up the most. And we don't really find ourselves in that space of the market because that is very important with our basic mantra of having companies with good earnings, quality, and to avoid massive damage on the downside. So this restart trade propelled a lot of beaten down stocks in India also to come up. The choice we have to make as a portfolio manager is that do we get into them? Do we get into them as a trade, make a quick buck and come out? But I think we have to resist the temptation and we should be okay with a little bit of underperformance 1 month because these always are a very big trap. It looks nice on the screen that stocks are going up 20-30%. Stocks that have lost 80-90% jump very fast. But if you very often get into this trading mode, you very often destroy the quality of your portfolio. So we are very okay to sit back and let this beaten down space come up. It is also very good, I think, for the overall market because the overall market cannot be a sum total of few stocks, just few quality stocks. The market breadth has to improve. The broader market has to participate. And that is how we are positioned right now. We stick to our core principle of being in good stocks with good earnings and where we have the longer term trend. There are short term, as I said, feelings that you want to make a quick buck and things like that and get into these quick plays of stocks that have fallen 80-90%. Maybe we get a good pop up. But as I said, the risk to an investor is very high because very often it compromises your portfolio and your portfolio balance. So this month, I want to share with you my thoughts on the market bottom. So everyone asks me that, oh, well, the Nifty has come back above 10,000. Was 7,500 at the bottom? What are the qualities of bottom? What stocks will move? So this month, I'm going to share with you a small presentation on my thoughts of studying the past bottoms and how their formation can be looked at. So I'm doing a small PPT share with you. You can see it on your screen. So the question that, as I said, comes up, has the Nifty made a bottom at 7,500? Well, first and foremost, what I decided to do was go and see the last three major falls. 1992, which was the Harshad Mehta bull market, we really don't have good data. So I had to bring it down to the last two major falls in the market, which was in 2000, that was the IT bubble, and second was the 2008. So first, let's consider the 2000 fall, which was the IT bubble. So prior to the bull market in 2000, for many years, the market did not do much. And between 99 and 2000, in about 15 months, the market went up 127%. So what you had was a very big bull market towards the last 15 months. And though the index was up 127%, the IT stocks were up over 1000%. In my life, I have never seen a sector outperform with such ferociousness as I saw the IT sector perform. So what we had was a very sharp, strong bull market. And as I said, in the IT stocks, it was absolutely crazy. However, the IT bubble burst because of a lot of excesses that have happened. And we saw an index that corrected 40% in one shot. The bear set in. However, even though it took 19 months to fall, the bottoming out formation was long because we had another very big incident that was the 9/11, the World Trade Center crisis. So the bottoming out formation after the fall in 2001 took another 2 years. So the fall of 2000 was not just one event, but two events. And what we saw was that the lead sector, which was IT stocks, got decimated 80 to 90%. Even marquee names like Infosys and Wipro had that percentage of fall. And many IT stocks actually just vanished. So this was the nature of the IT market. Remember, we had a 127% run in the index prior to the run up. And if we had an IT index, I'm sure that must be up 1000% because that is how the stocks went up. So when such runaway bull markets happen, you do see larger corrections. So as I said, the first hit was 40% and subsequently it fell more. But the important part is it took some time to consolidate. It was only in 2003 when we took out the earlier high of 1205 on the Nifty that we had the start of a bull market. And this bull market was another great bull market because what happened was that we saw the Nifty go up 600% in 5 years. So it had the makings of an amazing secular bull market that we have seen in recent times. Here, the sectors shifted. IT was no longer the top performer. In fact, a lot of IT stocks that even survived took over 10 years to reach the 2000 top. This led to the emergence of the infra, capital goods, and the real estate bull market, which lasted for 5 years. So this was the nature of the 2000 fall. I repeat, a ferocious bull market, a very big sell-off in the lead sector, time for consolidation because of the second event, but this also set the legs or the space for the next big bull market. So this is a cycle of booms and busts. Let us look at the next one, which is the 2008 financial crisis. As I said, the IT fall led to the start of another bull market. And you will find that the Nifty went from about 1000, which you saw in the previous slide, to 6000 in a matter of 5 years. So we had a 600% up move in the Nifty. And this was, as I said, led by cap goods and real estate. Again, we can see that the returns that we had got from these were not 600%, but a few 1000%. And that was again a very, very ferocious bull market, especially towards the end in 2007. This again led to excesses. And we had the financial crisis in the US. This was led, or the marquee name was Lehman, which faltered and went bankrupt. We had about a 65% decline in 15 months. That was extremely sharp. And even in India, we realized that the lead stocks, the infra, the real estate stocks fell almost 90%. And many of these names you will recognize that even till today are down 80, 90%. Your Unitex, Suzlon's, GMR, GVK, a lot of the Anil Ambani stocks, these were actually the leaders of the bull market in 2008. And you will notice that the US went on to do a lot of monetary easing. And this resulted in a very sharp and quick bottoming formation, which took about 6 months. And again, that created the next bull market. So as the Nifty crossed 3,100, we had a higher bottom, higher top in place. And we started another bull market, which lasted all the way and almost is one of the longest bull markets in the US, which is a 10-year bull market. So we had the market that went up for 10 years and it moved around 450%. So again, what you will see here is that prior to the sell-off, we had a ferocious bull market and the sharpness of fall was immense. However, it was led by those sectors or those stocks where excesses have happened. The bottoming was sharp because of massive pumping by the US Fed Reserve. However, what started was again another secular bull market. So now let us take it to this particular fall that we've had in 2020, which is the COVID fall. First and foremost is you realize that we never had a bull market in the run up to this, which was ferocious. In fact, you will realize that I feel many portfolios actually topped out in 2018. In 2018, we saw carnage in small and mid cap. So the excesses that had happened, those a few 1,000% returns were actually seen in the small and mid cap index. And in 2018, this blowout rally got fizzled out and there was massive damage. And these small and mid cap stocks fell 50, 60, 70%. Post that in 2019, we did have an index that went higher to 12,000, but it was extremely narrow and it was limited to a few names. So what I am trying to tell you is that in this fall, in the COVID fall, we never had a ferocious bull market like we saw in 2000 or 2008. In fact, investors have hardly made money in the last 2 to 3 years in the run up to the market. So we never had a lot of froth. We never had a lot of optimism. We never had a lot of leverage in the system. However, we did fall sharply. And because we had an event which nobody was prepared for. We had the whole COVID crisis. The market fell about 39, 40% in 2 months. March, April were disastrous months. Again, this time you will realize that the US Fed came and pumped in a lot of money. And what has happened is what I described earlier, that we've had a very big relief rally, which is really of stocks that were very, very beaten down. So it's almost a restart economy. As far as India goes, what is very, very significant is that we also have pulled back, though we've lagged US and global markets, but the index to cross 10,000 was a very, very significant thing. And we have done this bottoming process in 2 months. As you can see, the time frames have reduced compared to the earlier falls. The reason is the Fed reaction. The reason is liquidity. And globally, administrators, economists, or market leaders have learned that it is liquidity that is the big rescue for the market. And we are seeing this very big liquidity flow. This has led to a reflation trade. And that is what we are participating in right now. The interesting part is, what are our learnings? The important question is that has the Nifty made a bottom at 7,500? The first thing that we observe that the trend change, which we see is the bottoming formation in every fall has happened. As you can see in the red circle, our ability to cross and sustain above 10,000 is very, very important because this was a first pullback which failed. But however, the market has subsequently been able to take this out. So we have the makings of a higher bottom and a higher top in this. The second thing is that in all falls, we have realized that the lead sectors are not the first to recover. And we are seeing that again in Indian markets, that banking and financials, which were the leaders in 2019 and took the market higher, have actually underperformed. Bank and Bank Nifty has underperformed the broader Nifty. And this is again a confirmation of behaviors we have seen earlier. The third is that laggard sectors or underperforming sectors actually start outperforming. And this is something which we see in the pharma space. You notice that how a lot of pharma stocks have made new highs. And the whole pharma index, which was underperforming for 5 to 6 years, has emerged as a new leadership sector. Along with this, with time, we will see that more and more sectors will come into the play. But the most important thing is that the leadership sector, the sector that led the bull market, actually tends to underperform and new leadership emerges. So this is the genesis of the issue. So if you ask me, Has the Nifty made a bottom of 7,500? Probably yes. The only risk in this scenario is that we are dealing with a very big unknown, which is COVID. Unless until we do not have a massive spurt in global cases and we have to go in for another lockdown, which honestly nobody has the answer. I am hardly a scientist, and even the scientists don't have an answer to it. But assuming we don't have another disastrous outcome as far as COVID goes, I feel that the markets have a base in place, and it becomes a very interesting setup to start another bull market. As far as we are concerned, we have been very proactive. We have shared earlier, and you have seen it, that we have exited some of the stocks which were very, very vulnerable to COVID very early. We did that with PVR, the stock more than halved after that. We have also reduced our weightage to financials. Uh, it may be a little controversial, but the fact is that we have seen a break of trend in a lot of financial stocks. We have gone overweight pharma, which I think is the new leader of the new rally. And also we've put our weightage or increased our weightage towards the whole offshore production. So specialty chemicals come into this space. And here also we've increased our weightage. I would like to end that I know people are fearful, people are doubtful. When the markets were down, people thought that, oh, we will go to 6,000. Now when the markets have bounced, people think that it is a rally which is very, very distant from underground reality. But the fact is that in our market, ultimately, it is your emotion which is going to be the victor. So to summarize with a beautiful quote by Warren Buffett, which says that be fearful when others are greedy. But this is a time when most people are fearful. So it says, be greedy when others are fearful. So with this, I come to the end of this month's sharing with you. So to summarize, what you have really seen is a very big surprise pullback rally. We have been participating in it, and we feel that as long as we do not have a crazy outbreak, a second round as far as COVID goes, for which none of us have an answer, I feel that the markets have put a base in place. The important thing is that we will see a sectorial churn, a leadership churn, which we've seen in the other falls, and we are doing that with our portfolio. So on that note, I leave you for this month. Stay safe, stay strong. We continue to preach and practice what we talk about, which is cut your losers and ride your winners. With that note, thank you for this month.